Hi, Larry Gaines, PowerCycleTrading.com. In this video, I want to show you what we call a retracement failure short trade setup. So when in trading, what I've found over the years of trading is that it really comes down to direction, timing, and then managing your risk through using good option strategies. So here's the S&P 500 SPY, and we've got a major area of resistance that we've been watching for some time, and that's coming in. That was coming in right here at 264 on the SPY. That was a trend line that got broken, and typically, technically, a lot of times you'll have a retracement to a break of a major trend line, also a 382 retracement, and also the 200-week moving average. So we were looking at this very closely for potential failure of this 20% up move. So the thing that told us the potential for failure is based on price momentum. So looking at the 1 hour time frame here, actually the 30-minute and the lower time frames, this is what we call a volatility squeeze. So you can see that the market on the SPY came all the way up into this key area of resistance right there, that 264 over the last, yesterday, Monday and Tuesday. And then we had this volatility squeeze, and the momentum was telling us the probability of direction was to the downside. So ahead of time, we had some strategies set up that we were going to do if we had a break. So right out yesterday going into the close, we set up a very low defined risk trade using an option butterfly, what we call a wide wing butterfly. So here's what that looks like. So I wanted to use a very defined risk directional trade, and did that using a butterfly. So here's a $10 wide butterfly using puts. So this is the 250, 240, 230 put butterfly for next week's expiration. Set this up yesterday afternoon, going in towards the last part of the day, the last 30 minutes at $80 per spread. So the maximum risk, if you get this thing wrong and the market starts going straight up or collapses, goes straight down, would be $80 per spread. Now, today it went out up $56, and it was up, close to $70 at one point, because we were targeting, our first target was down here to right where it hit here, 245. Our next target's right here to that 50% retracement, about 240. So this went out with that's about that's a 70% return on the capital risk per contract. Now, if we get a move down here tomorrow, let's say the markets start to really falter, and we move down to 240 tomorrow, this trade would be up to $84 per spread, 100% return. And then next week, though, that's where it really pays off. So next week, if we were to come in on Thursday the 9th and it's trading at 240, this would be at 358. And at expiration next week on the 9th, we'll have the 9th or the 10th. Hold on, we've got a holiday next Friday. So on the 9th, this trade would be up 358. But if it goes into the close next week on expiration, this thing will make, theoretically, it could make $920 per spread on the risk of 80. So that's over 1,000% return. So these are the types of trades that are great in a kind of market where you have high volatility, extreme market conditions, because if you are wrong with the volatility, you can keep your risk low, but if you get it right, you have a huge payoff. So if you'd like to learn more about these strategies, but also earning strategies, we've got a new earnings season coming up, and I'm going to be doing this Saturday a free interactive webinar on earning strategies for this high volatility season. So make sure to sign up and join us, and hope this helps, and I'll talk to you on my next video update.